Okay, let's look at some standard legal terms. Now, you probably hear a lot about common shares, preferred shares. Common shares are just basically what you give to your employees. When you go out and start to raise capital, what you're going to be dealing with is preferred shares. That's what investors want. So if you think about it, it's exactly what it sounds like. It gets preferential treatment to common shares. So be aware of this, and I want to stress that you always want to consult with an attorney before signing any final version of the term sheet. And all the legal terms I'm going to describe here are going to be very basic, high-level detail, and your attorney can sit down with your final term sheet and make sure that there's nothing in there that's going to surprise you when it finally comes up. So again, these are really just basic, standard legal terms. The next one's liquidation preference. It determines how the proceeds will be distributed once there's a liquidation event. So if the company goes public, if the company is acquired, how will they distribute the proceeds? Now, the average liquidation preference I see is about 1 time. So again, consult with an attorney, but if you see something higher than 1 times, then it's kind of a red flag. You want to ask your attorney about that. Rights. Preferred shareholders, as you probably could imagine, have rights. So you want to make sure that you understand all of the different voting rights. Some of the rights that you want to look out for is the right to vote down an acquisition. That it's kind of common these days. We see it a lot, but I've seen it with clients where it becomes a problem, where they want to sell the company and the investor has the right to say no. So if you see that and you're comfortable with that, fine. But if you're not comfortable with that, you want to make sure you understand. And there's lots of different types of rights. This discussion in this video is definitely not exhaustive. There's so many more. But these are kind of standard legal terms that we see poking up and causing problems: liquidation preferences, rights, those types of things. Again, always consult with an attorney. Valuation. So you're going to have a valuation more than likely in your Series A. When you do your seed round, you're probably going to go for convertible note. As we discussed before, convertible note does not require a formal valuation. You may do a valuation cap. And for a lot of people, they think when they're putting a valuation cap on, it's kind of implying a valuation. So I want to discuss valuation only for that purpose of just getting a range of what you think your company is worth. So the most common way of getting a valuation is related transactions. I don't want you to do a discounted cash flow, which is commonly called a DCF. That is for later stage companies. I don't want you to look at publicly traded companies in the market because, one, the IPO market has not been that hot for the past 5 years. It's just been picking up lately. And two, those companies are publicly traded. So it's definitely a different ball game. And if you do use publicly traded comparables, make sure that you discount them down, chop it 35%, because you're not a liquid company. You're not easily bought and sold on an open market. So there's some issues with liquidity there. But what you really want to do is just focus on related transactions you see in the news. So research comparable transactions for your space, and you want to use these during negotiation. So valuation, as I said before a few sessions ago, is only one part of the deal. So really focus on getting the right investor in there. That's somebody who has knowledge, expertise that can really grow your company. Somebody who wants to be active, somebody who really wants to help you when things are going right and when things are going wrong. And then valuation's kind of secondary. Valuation's not super important. I like to always stress that the average valuation's about $2 million. Of course, it could be lower or it could be higher, because I want you to understand that there's a certain range that's fair. Of course, you probably see in the news that companies get extremely high valuations. I like to think those are outliers. That's why they end up in the news. But every day, companies get valued at a very, very much lower price. But just be aware of what's out there. Make sure that you're getting in the right range. Balance your valuation with the quality of your investor and the context that he or she can bring to the deal. Don't get so fixated on getting a valuation. And the last thing I want to say about valuations is don't compare what's going on in the news to what's going on with your company, because that's a very, very common mistake I see, where entrepreneurs seem to think that their company is worth $1 billion because Instagram is, or some other company that they're reading about. Research comparable transactions, companies that are very similar to yours. I like to say get about 10 data points. When you have 10 data points, that's enough to really say, okay, we have a good sample size. We can go with this valuation range. All right, so that concludes this section, and we'll pick it up in the next section.